Welcome to Onward, the Fundrise podcast. We are recording this on Wednesday, February 11th, 2026. And before we start today's show, an evergreen reminder that this podcast is not investment advice. It is for informational and entertainment purposes only. And now let's just get right on with the show. This is the Going Public So You Can Stay Private episode. I'm Cardiff Garcia of the Economic Innovation Group, joined as always by co-host Ben Miller, CEO of Fundrise. Ben, you have a very exciting announcement for the audience today, I think.
Yeah, I'm so excited to be here with you, Cardiff. This is like all new for you too, but we are taking our innovation fund public on the New York Stock Exchange, and we're going to do that in a whole new way in lots of ways, right? So we're going to do it on a podcast. We're going to do it in a direct listing. And so all these new things are going to be like wild for us, and so I'm excited to walk through it with you.
Yeah, you have a lot prepared. As usual, you like to keep me in suspense in the same way that the audience is also in suspense about what's going to happen. But first, let's unpack the announcement you just made. So Fundrise has an innovation fund. Why don't you just give people a quick reminder of what it is and why it's such a big deal that it's about to go public?
Yeah, we're doing something essentially like maybe no one's ever done, and that makes it like exciting and a little scary. And so I have this presentation I was going to walk you through. It's all about democratizing markets. And so let's do it.
Let's just go right into it. Okay.
Yeah.
Again, I want to be clear. I have not seen what's in here behind the scenes before we started recording. Mm-hmm. You were like, don't look while we were setting it all up. So I'm going to be as impressed by this as the audience is because I haven't seen it. So let's get right into it. All right. Why don't you start the slideshow?
Yeah. Okay. Well, so the whole idea here is that we're trying to bend the arc of finance back towards democracy. You know, there's been a sort of growing inequality in America. The markets have become more and more sort of like exclusive, and so our mission has been for over a decade to do that. So that's what this presentation is all about. So okay, next slide here. So. Fundrise was started about 15 years ago, and the whole mission was to build a better financial system for the individual investor and get them access to the best investments. Like that's our goal.
And specifically because investors were shut out of a lot of markets, unless you're a very high net worth individual or you're an institution, the typical investor did not have access to private markets in particular, which is Fundrise's bread and butter.
Right. Okay, so we started, next slide. So we started in 2012, and that was a different era really at this point. And at the time, no one had ever taken private markets onto the internet and sort of democratized investing into real estate. We went to the SEC, the Securities and Exchange Commission, back in 2011 and said, we want to do this. We spent probably a year or two making it happen. And we were the first to ever take a real estate property and let anybody invest in it at $100 a share. And we had this great article written by this reporter that was like our kind of like launch article. Like we were doing it for about 6 months. Nobody paid attention. And then Emily Badger wrote this article called "The Real Estate Deal That Could Change the Future of Everything." And it got like thousands of retweets, and all of a sudden, like it became electric, and that was our launch. And so the point is that like this thing we've been trying to do, we've been doing for a long time. And to do this, we've always had to do things like that were new, that were like the first ever, pioneers. Pioneers get the arrows, so we've gotten our share of arrows here.
Especially if at the time you're competing with the longstanding real estate private equity industry, but for people to invest in those funds, for decades, you had to be able to invest hundreds of thousands or millions of dollars. Now you're saying this was available to people for as little as $100 a pop, right?
Yeah.
Okay, we launched in 2012. All right.
2012. Okay. And then next slide, in 2015, we were the first to create like the sort of fund structure where we brought, we call it an E-REIT, but it was a private fund, private equity fund that we then made available to anybody in the country. I think over time, we lowered the minimum to $10 a share. And that was just another first. It was like the first filing under Regulation A. And, there were a lot of things we had to do. Like when we did these things, there's so many small the things we had to invent, like how do you check out for a share of real estate? When you're buying something online, like Amazon, you can buy shoes, but how do you buy, a share of a real property?
Like the basic logistics of how to set it up.
Yeah, logistics.
It was all new.
And the way, just like the actual, what does somebody do when they're going through checkout? What are they actually expecting? So anyways, we have done a lot of things over the years that were like a new thing. In 2021, next slide, we created the first public non-traded venture fund. So the first non-traded public venture fund, we went to the SEC again and we said, you can invest in real estate and anyone can do it. It's online, it's low cost, it's very efficient. Why can't you invest in private tech companies? Why can't you invest in venture capital?
Right.
And so we went to the SEC. It took us a year or two to get through the process with them. And we were the first to file this concept of democratizing venture capital.
Okay.
Cleared that. That's 2021. And that has been surprisingly successful. Well, I guess we filed in 2021 and we cleared in 2022. And so now we're going sort of the next first, if you go to the next slide, like all of the work we have done sort of take us to this moment where we've really built a company that has got scale. We have more than $3 billion of equity under management. We have millions of customers. We have in real estate, we've scaled to tens of thousands of residential units. We've been around for a decade and a half. The team's 200 people. We have 100 tech professionals, engineers, software engineers. So we really know a lot about tech, private markets, investing, and then probably the most painful learning is how do you work with the regulator to basically do this, right? So we have 3 public investment companies. We've cleared 108 public offerings with SEC. We've literally gone through 108 separate review and get cleared, an offering with SEC, which is it's a lot.
I can see it in your face. So I do have one reaction to all that. And I have a feeling that especially people who are relatively new to Fundrise and to what you do are going to have this question as well, which is you've been doing real estate for a long time. Your background was in real estate even before you started Fundrise. What was it that earlier this decade convinced you it was a good idea to also get into tech? What was the vision there initially?
Yeah, I think we essentially succeeded in democratizing real estate investing. It became actually so normal that people don't even know that we invented it. That's how you succeeded when it's just become,
when you're forgotten.
You're forgotten, and it's just become something that people assumes always existed. And so we were thinking about what's another thing we could do that our investors would be excited about, that we know about, and our team, we have a fintech platform with payment processing and APIs, and we built with AI. We built a whole real estate AI product called Real AI. We have just a long-standing amount of experience building software. And I've actually been investing in tech, going back to actually the late 90s. So I've basically been around the block on as an investor, as a builder. And when we saw what was happening in the technology industry, we really saw a need. So we started thinking about what could be the next thing? And that's really how we came upon this. And I want to walk through essentially the problem we were trying to solve. But that's I think we have more technology experience than most venture people. And we definitely have some investment experience too.
Yeah, one part of the story that I think is especially compelling, I have a feeling you're going to get to this in some of the slides coming, right, is that Fundrise was itself using a lot of new technologies, and that is part of the reason you were persuaded to get into this space, was that you had direct experience with these technologies, and with trying to sort of capture the technologies that were emerging at the time, earlier this decade, maybe at the end of the last decade. This wasn't just it would be fun to pivot into tech, but we don't know anything about it. Let's give it a shot, right? this was because of the direct experience that Fundrise had in implementing these new technologies. And then it was a more organic process than just, oh, let's try tech because what the hell.
Right. And also we've raised venture rounds. And so we've had I've been doing this for a long time. So, okay. So let me just get to like the
slide.
The next slide here, which is like, what's the problem here? Why are we doing this? Because it's not been easy. And what we're talking about doing is sort of the next mountain to climb. And so let's go talk about the problem for a minute. And then I think it'll explain why we're doing this. So slide 8 is about how the way technology companies are funded and owned has changed a lot over the last 15 years since we started Fundrise. So fewer and fewer companies are going public. And if you look at this slide, you see that like there were way more public companies. There were something like 8,000 25 years ago, and now there's only 4,000. So companies are not going public like they used to. There's less public companies. And there's a reason why that is, but it's been a big shift to who gets to invest in, who gets to own, the next great thing in technology.
Yeah, the reason, by the way, is that so many private companies can stay private for a lot longer, right? Maybe it's because of some consolidation as well, companies buying each other or something. But a big part of the reason is simply that companies don't go public as much because they don't have to anymore.
Right. Okay. I think there's two main reasons. So if you go to the next slide, I think the first reason is that being public company is not fun for the company.
Right.
You're there's this like if you don't have to go public and you can stay private and you can access capital in the private markets, public markets have a lot of like negatives. And so if I go to the next slide, right, here's this, I have a couple examples. So I don't know if you know this tweet where Kylie Jenner talked about how she doesn't use Snapchat anymore.
No, I didn't see that. That's too bad.
Yeah. So she tweets that she doesn't use Snapchat anymore and Snapchat's value falls $1.3 billion.
Snapchat's probably wishing Kylie Jenner could have just taken the don't say anything option, right? If you're not going to use it, don't use it, but you don't have to tell everybody, right?
Yeah. I mean, the point of this is that there's a lot of sentiment, and the sentiment can move the price a lot in a very short amount of time. So everybody knows this, but the public markets are super sentiment sensitive. So sentiment it can change in a day. It can be really positive. It can be negative. We've been seeing this with AI. And so it's so very sentiment driven, which is not fun if you're the company, if you're the executives, and you're managing all this sentiment driven decision making rather than fundamentals. Okay, another great example, next slide. I don't know if you know this one, where Netflix, they actually had, I think their customers shrank by 0.1%, and they lost 25% of their market value in a day.
Yeah, because it's driven by expectations, right? Like people thought they would keep growing. The fact that they had stopped growing momentarily, at least, meant that your stock price collapses that day.
Yeah, and the reality is like Netflix got back to growth. But if you're a public company and you're going to get hammered for one day, one metric, a short-term, reporting issue, like that's just painful. It's so painful. If you're trying to build a great company, all of a sudden you have, 25% of your market cap wiped out by missing something by basically a fraction of a percent. Like that's not like very fun for the company again. And so here, another example, I'll do one last one, which is like, this happened, I think it was like a week or two ago, but Amazon had really strong sales. They basically, their sales were up 14% in Q4 2025. Their revenue was up 24% for AWS. They said they're going to invest a lot in AI. They're going to invest in the future. They're going to grow their business, invest $200 billion, and their stock falls $200 billion in a day, right? Like that is just like, wow, if you're trying to build a big company and you're trying to innovate and you're trying to invest, and the public markets are punishing you for it without really knowing that much about how you'd think Amazon's closer to the right decision. It makes companies not want to go public.
Sure. Yeah. I will say that for the system overall, it's a healthy thing that public markets react to information, right? It enforces transparency, can enforce a certain amount of discipline, but there are trade-offs, right? And I get it that from the standpoint of somebody running a company, it's nerve-wracking, But people are going to see this, Ben, and be like, nobody should ever go public ever. I think you're about to pivot into something else, into a different lesson. But I get what you're saying.
I don't know. I mean, there's definitely benefits of public markets. Well, I don't want to get too far down the rabbit hole debating how good the public markets are at driving the right decision.
Right. Future Onward episode.
Yeah, because I would argue that a lot of the great executives ignore the public markets. Like NVIDIA is famous for getting hammered. If you go back to when they started investing in AI, which was like 2009, 10, 11, 12, their stock was hammered. The public markets hated their investment in AI, and it was like overnight when the markets realized they're wrong. And so I feel like actually only the greatest executives can weather and ignore when the market's wrong. A lot of times, actually, I don't know. We don't have to get into it. Okay. Anyways. Okay. Moving on. Next slide. Okay. As you said this, right? So private markets have grown like crazy.
Mm-hmm.
So the size of the venture capital markets, like when I started venture I worked for a venture capital investor in 1997 when I was in college. And, the size of the venture market was like in the single digit billions, like, maybe 10, 20 billion, tiny sector. And now it's 1.4 trillion.
Yeah. It's
grown like crazy. And this is it. So if you can raise your scaled dollars in the private markets and not get punished with all this sort of volatility and public market like activism and all the
regulation you have to submit to. Sure.
Yeah, nonsense. All the stuff that makes it like, more difficult to run your business. You don't need to. You're not going to. Mm-hmm. And you don't.
And you don't. And they haven't.
Yeah. Like I was thinking about like another, I don't know if you saw last year, the public markets, I think raised something like, it might have been like $25 or $50 billion in fundraising for tech companies. And the private markets raised $400 billion. So the private markets raised like 10 to 20 times more than the public markets for tech, for AI and all these, cutting edge companies. And so like at this point in some dimensions, private markets are bigger than the public markets. I mean, that's wild. That's such a change to the world. And this happened, if you look at this graph, you look at the data, I mean, this happened in the last 15 years. It's very recent.
It's an incredible graph. And it's something that almost by definition, people don't realize because it's in the private markets.
Mm-hmm.
You know what I mean? I mean, if you read the newspapers all the time or you're in this space, then of course you're aware that this has happened. But I think just the average person who just wants somewhere to put like their savings or their retirement money or whatever, they're not aware of this because it's something that you don't see. It's not on the stock market. It's happening in the private market. So they're just not aware that
it's private.
This whole separate thing exists. Yeah.
Right. It's away from the public attention. So, okay. Let's go next slide here. Mm-hmm. So I have a couple of examples of the downstream consequences. These are fun. So Amazon went public after being in business for 3 years. They were a 3-year-old company. They went public and they created $2.2 trillion of market value for the public investor over their history. That was back in 1997, 1998. If you next slide, Meta goes public 8 years into its history. It's an 8-year-old company. It's at the time it seemed like, Meta's going to public a little late, and it creates like $1.4 trillion in the public markets for the ordinary or their everyday investor. And so this is sort of like, but you're seeing the sort of the pattern. If you go to the next slide, Uber goes public 10 years into its history, and half of the value was captured in the private market and half was captured in the public market, right? And then you go to the next slide, Airbnb. Airbnb goes public 12 years into its history, and actually, it's down since it went public. So all of the upside so far was captured in the private markets.
Yeah.
And then last, and this is coming up, SpaceX. SpaceX is saying they're going to go public at a $1.25 trillion valuation. And at that point, 23 years into the history of the business. So they're going public, staying private longer, as you say. They're going public later. And all of the value so far has been captured in the private markets, trillions. So we're talking about trillions. And so that's like the downstream consequences of the stuff we're talking about, which is that more and more value is being captured by the private markets, where it's high net worth investors, institutions. It's exclusive. It's insiders. It's not, my 401k. It's not normal, the normal everyday investor who have had a great return, had their 401k has been doing great. It's been one of the sort of the best things in the U.S. economy over the last few years is that, okay, the job market's not so great, but my 401k is doing terrific.
Yeah, it's a good point. It's not that these companies necessarily stay private forever, although some might try for all I know, right? It's that the later that they go public, the less the ability of the average investor, the average public markets investor, to capture some of the enormous growth that these companies can show. And so as you just showed, you're like, who knows what SpaceX will do if it ever goes public, right? But for these other companies, just a smaller and smaller share of the growth is being captured in the public markets, right? It's not for every company, but those are some pretty salient examples there.
Yeah, right. Okay, so let's go to the problem. So they have this problem, right? So you have public investors and you have private companies, and there's like this wall. It's a combination it's a regulatory wall. Private markets are not regulated like public markets. There's all these reasons why there's barrier between these two worlds, and there's a problem. And so people have been trying to solve this problem different ways. So like one way, if you look at the next slide, is make the private companies go public. There's been a lot of people, you see a lot of people who are journalists say like bemoan that we should force these companies to go public. They shouldn't be allowed to stay private. That's not a great solution. So
I don't know how that would work exactly. You know what I mean? Like, who's doing the forcing in that case?
Yeah, I mean, I think it's more like complaining.
Okay. Well,
it seems like, but anyways, a lot of people say,
practical.
You see, I mean, I know lots of journalists, they say that they tell me like, oh, why don't they go public? Like, because, they know this problem exists, and they said there's sort of a general sentiment of like, why can't we get these companies to go public? And, there's been some work by Commissioner Atkins about, SEC Commissioner Atkins about trying to make public markets a little friendlier to private companies. But generally, the essence of the idea is like, try to get these private companies public.
Yeah, I would say this, by the way, as somebody who once was a journalist for many years, you can apply that kind of complaint maybe to one or two companies if you want. But when you look at how many companies and you look at the sheer scale of the trend, it means there's something systemic going on here.
Right.
You can't just say, oh, these companies and their, stupid CEOs or whatever. That doesn't really make sense when it's so many companies. And when this has become almost the default choice, which is to stay public or to stay private a lot longer.
Right. Yeah, right. So then another proposal, the next slide, is the opposite. Well, can we lower the barriers and let the public become investors in private companies? And so like the SEC has proposed different ideas around, changing the accreditation standards so that, you can be able to invest in a company without being accredited, or you can like take a test. There's lots of different ideas of like, how do you get public investors into the private companies? And that proposal doesn't really work for lots of reasons, which I'll get into. But a few of them is that so a private company under the regulations can't have more than 2,000 investors. If you're a private company, if you're SpaceX or Stripe, you're limited to 2,000 investors on your cap table. And if you have more than 2,000 investors, you have to register as a public company. And so even if you could get lots of people becoming accredited and accessing these companies, the companies don't want it. And so like that proposal falls down for a bunch of reasons. Just one other sort of important one, because if people don't appreciate how the private markets work, is that like to invest in these companies, you typically need the board of directors to approve. Like if Cardiff's gonna buy $1,000 of Stripe, the executives of the company and the board of directors has to approve that. So there's like that. This idea doesn't actually make any sense in practice.
Yeah, this has also traditionally been a debate between how much to democratize markets versus watching out for the safety of smaller investors.
Right.
right? So smaller investors investing in these private companies where there's maybe not as much transparency as there is in public markets. Like, okay, you don't want smaller investors to like lose all their savings in these companies that they didn't really understand. And so you end up trading off a little bit of democratization of markets in exchange for more safety for those investors. But of course, it also leads to the imbalance between who gets to invest in these fast growing companies. That has been, I think, the traditional tension there, right?
Yeah, and I think that's right. I mean, I think that the regulator has to own the investor protections, and there are real risks and there's real harm. And so I don't think that I'm not saying that they should be able to like have this sort of wild west. I think these challenges, these systemic issues you're raising, they're hard problems to solve. I mean, this is the reality. So let me just go to the next slide, because I feel like one of the things that people don't know, as you said, private markets happen away from the public, is that how do private markets actually work? And so if you are a high net worth investor, if you're really well, maybe you're worth $10 million or $100 million, you are still not investing directly in these private companies. Like even the largest pension funds generally invest through a VC fund, and the private companies have VC funds on their cap table. The investors in the private companies are generally a venture capital fund who has raised money from pension funds and endowments and super high net worth investors. But the idea that the companies are directly held by individuals in the private markets is really unusual.
Yeah.
And so that's something I think people don't realize, that you're trying to make the private markets look like the public markets without appreciating how the private markets work a certain way for a certain reason.
Yeah. And there's a lot of path dependency there. It's been that way for decades.
Yeah. And like, there's good reason for the way it works today.
Okay.
Right. As you said, the systemic issues come out of a lot of reasons, not just like regulatory.
Yeah.
So if we go to the next slide, like, so we have this, like the public markets, to remind people, like where public investors invest in public companies, and a public company may have, 1 million investors in it. And a private company will only have 2,000 or maybe even 100. Like think about it. If you're a $1 trillion company, like maybe SpaceX, and you only have 2,000 seats at the max, each investor investing like,
that's a big number.
That's a big number minimum.
Yeah.
Yeah. So like the idea that the public needs to be investing directly in these companies, it doesn't really hold up to how the markets work and how the companies want to interact with their investors, right? They don't want to have a huge IR team dealing with thousands of people asking them questions, right? Yeah. They want to know their investors. They want their investors to help them.
And those investors each, as you said, just in sheer mathematical terms, are putting a lot of money into it. Like the average amount is huge just by the sheer size of the company and its valuation.
Right. I mean, if the company has to approve it, they don't want to go approve some small number. They want to approve like millions, tens of millions, hundreds of millions.
Yeah.
Okay. So next slide. So we have this question, right? Which is like, okay, what do you do? We have a problem. Everybody recognizes the problem in the capital markets. People have been trying different things. And so we have this idea that we're gonna bring to the market, bring to the world. And that idea, which is next slide, is VCX. So VCX is this concept of taking the innovation fund public under the public ticker VCX. So, lots of companies have a stock ticker. So the innovation fund stock ticker will be venture capital X, right? VCX. And
can I just say the reveal was too quick? Okay. The reveal was not theatrical enough. Right?
Okay.
We needed to pivot to the camera and look and show that this is the ticker then. This is the solution to the problem you've just spent some time laying out. All right. So there it is, folks. VCX.
Yeah. And I want to explain why this makes sense for so many reasons. So if you look at that, right, the private markets work by having a venture capital fund invest in their company. That's how private markets work, right? The public markets need transparency. They need regulatory oversight. They need liquidity. They need all these things. And so democratize the bridge, democratize the venture fund, And that's the big idea. That's the big innovation. And so I want to walk through that idea of how it works and why it's such a good idea. And, so if you look at the next slide, the next slide is actually meant to be the big reveal. This
was the big reveal right here, right? Yeah, we front ran it. Okay.
This is not my day job as a public speaker. So
that's all right. This was dramatic enough.
Yes, there it is. The public ticker for private tech.
Very nice.
We are trying to create a new category, and I want to walk through this idea of the sort of category creation. And the idea is to have a public ticker like an ETF for a portfolio of the best private tech companies.
Yeah. Good alliteration in the name, by the way. Public ticker, private tech.
Thank you.
Right?
Thank you.
I like it. Very clever.
I may have come up with that one. Okay, next slide. So we think that this concept of VCX combines the best of what works in public markets and private markets. So it democratizes venture capital, and you end up with the best of both worlds. So let me just see if I can persuade you.
All right.
That we can have kind of a win-win here.
All right. Let's do it. And
okay.
The next slide is the one that's going to do it, I think. Right?
That's the hope.
All right.
Okay.
Let's see.
So, we're trying to create a new category in finance called a public venture capital fund, a PVC.
All right.
PVCs, like ETFs. We're going to create PVCs. You heard it here first. Someday somebody will forget that I created PVC.
You coined PVC.
I just coined the concept.
Nobody's done this before, right? Okay, great.
No.
Great. Here it is. This is the moment it happened, folks.
Yes.
February 11th. Right.
Hopefully someday someone will have no idea.
We'll forget that you coined
that
PVCs. That will represent success.
It's like index funds and ETFs. Nobody has any idea.
People know who John Bogle is still. So,
okay.
So who knows?
That's an aspiration for me.
All right. Take me through this slide. What does it show?
Yeah. So, what is a public venture fund like VCX? And what is a private venture fund? And how are they different? Mm-hmm. Okay. So both private and public venture funds invest in private tech companies. Okay. Check. Both are professionally managed, right? Both have relationships with founders, are buying and selling and managing the investments to make sure, hopefully, you have good outcomes. But then there's a big divergence between, I think, what a public venture capital fund would be, a PVC, and a private venture fund. And the divergence is that a private venture fund wants to be on the board, wants to be maybe active, I would say micromanaging at times.
Intrusive is the word you might be looking for there. Is that it?
I have a board. I built a company. We can debate how much value there is in that, but definitely is not what a public venture capital fund is supposed to be doing, in my opinion, and the way the regulations work. And so there's this big split between active and passive management. So the PVC ultimately wants to be more like an ETF for private tech companies.
Okay.
And so that's a big difference. The other big difference, and probably the biggest difference, is that a private venture fund is illiquid, right? When you invest in a private venture fund, people may not know this, but you usually put your money in. It's a blind pool. You don't know what you're going to get, and you're invested in it for 7 to 10 years, even sometimes 12 years. So it's this long illiquid lockup, and a public venture fund would be daily liquid. So it's a huge, huge unlock for capital markets.
Yeah. Lot of follow-up questions.
Okay.
So I actually don't know if we should keep going and let's through it, and then I'll save the questions for the end. It's possible that you're about to hit some of the.
Well, maybe not. Let me make one more point, and then
please.
You can. And lastly is that a lot of the questions about democratizing private markets is about investor protections, about transparency, about oversight, and so public venture funds, a public venture capital fund, would have SEC reporting, a lot of SEC requirements around governance. There's a lot of compliance, and a private venture fund, it's private. It's a free market. It's a free market vehicle, and so there's very little, if not zero, regulatory oversight. So there's a big difference between these two kinds of models, and I think that they're symbiotic. And so we're trying to create this new structure I'm trying to call it PVCs.
PVCs? All right. So here's, I guess, my first question is just, you have the innovation fund right now. Is the idea in its most basic terms just that you're going to convert the shareholders who are there now, or I guess I should say the investors who are in the innovation fund now into public shareholders of the new fund? Is that how this is going to work? They're going to have the ability to sell their shares, presumably. Like, are you raising new capital? Like, what does the transition sort of look like?
Yeah, I mean, it's a lot like when a private company goes public. So if you invested in a private company and the company went public, usually there's a 6-month lockup, and then your shares are liquid. You can hold them, you can sell them. And so what happens is if you invested in SpaceX 23 years ago, you probably would have held them, which would have been a good idea. And if it goes public, then they're liquid. You can trade them. So when we take the innovation fund public, if and when, if you were a shareholder in the innovation fund and you had 1,000 shares, and then we list, you'll still own 1,000 shares, except for now they'll be liquid. You'll get them moved into your brokerage account. So if you have a shares today on Fundrise, you would move those to Schwab or Fidelity, and then after the 6-month lockup, you can trade them the way you trade any stock on the public exchanges.
So traditionally, when a company goes public in kind of an old school IPO, they also issue new shares, raising new capital. I don't think this is a traditional IPO, right? This is something a little different. So are you going to issue new shares and raise new capital, or is this going to be a situation where the shares available to be bought by the public, right, are going to be the shares of the existing shareholders?
Yeah, we looked at both options. So there's 2 ways you can do it. You can do an IPO where you raise money from usually institutional investors. They come in, you sell 8 to 15% of the company to these new investors, and those are the shares that trade. And frequently the shares pop because the investment bankers running the process want to reward those sort of institutional investors who came in to facilitate the public offering. The other way you can do it, and some companies have done this, is direct listing. So Spotify did this, Coinbase, I think Palantir might have. And so they don't raise any money from the public markets. They just go public, and then their existing shareholders can sell their shares. And so there's 2 different approaches. We went down the path of not doing an IPO. I looked at both, and I can tell you a little bit about both. It was an interesting experience. And we chose not to raise money for institutions. Essentially, like, I'm a bit anti-institutional.
I can tell. Yeah.
The whole point of this is to reward the individual investor, not reward these institutions come in last minute. So we didn't. So we chose to do a direct listing.
Okay, great. My other question, and this I have a feeling you are about to get to it, but let me just prompt you anyways, is more about the concept of what you're doing, right? So these shares are going to be public, and as you said earlier, obviously, individual share prices can fluctuate wildly. So if once it's public, these shares also fluctuate a bit, what does that mean, if anything, for the underlying portfolio companies?
Yeah, that's actually the most frequent question. I actually have that at the Q&A at the end.
Oh, great.
So,
all right.
But yeah, the question is, okay, if you are invested into like the top tech companies and you're invested in through a venture fund, and the venture fund, you're probably typically you're paying a venture fund at a normal fee structure is 2% annual asset management fee plus 20 to 30% of the profits. That's the normal fee structure. You pay a private venture fund, and also you're locked up for 7 to 10 years. Our public venture capital fund, or VCX, there's no carried interest. There's no 20 to 30% of the profits given to the manager. There's just a flat asset management fee of about 2%. We'll see exactly where, but approximately 2%, could be 2.5%, 1.85%, but it's the fee structure is much, much lower than private venture funds because you don't have that carried interest. So that's one of the biggest differences. The cost structure is so much lower in the public markets.
Mm-hmm.
But anyways, so the question is, if you had to hold a portfolio of private tech companies that were valued in the private markets, and all of a sudden now it's liquid, and you can trade it, and there's a lot more transparency, where should it price? Where should it trade? And that I'm going to get to later. But right. I think it's like a really, really good question, and nobody knows the answer to.
Yeah, interesting. Yes. Yeah, and I'll have a few more as we go along, but let's plow ahead because this is exciting.
Yeah, I feel like now that we're doing this presentation, I might have moved this slide earlier because the next slide is about this sort of like this history of innovation finance. Because we're trying to create this PVC concept, and it's actually like there's everything we take for granted is actually something someone invented. And so if you go back to the mutual fund, which everybody knows, mutual funds, you've taken for granted how people invest a lot of their savings. Those were the first really scaled mutual fund was invented by Fidelity in 1946 when the public markets were tiny. Vanguard, Bogle invents the index fund in 1976. And then you have the sort of the invention of the ETF, which is like Spider, which was State Street. And everybody knows Spider probably at this point, SPDR. Invesco invents QQQ. Another one is actually...
And now there's zillions of these things.
Yeah. iShares was also invented about the same time as QQQ. And so the point of them is that like they're a innovation to make a investment more basically simplify, lower cost. Like it's, all these things that have happened in the past, like they are a combination of regulatory and sort of business practice innovation, but they end up making it easier and more democratic for people to do to invest. And so VCX is very, very consistent with that because you're taking something that's very common and reinventing how it works. And, the size of the public markets and the number of investors has grown enormously as a result of these financial innovations.
Great. All right.
Okay.
What's next?
Okay. Well, this is what I was talking about, the first PVC. We can probably keep going.
Here's nice visuals though.
Yeah. Let me have this. Let me just do this. If you look at the next slide. So this is a design I made that my design team hates. So they may make me cut this from it, but I'm just going to...
Nice try,
design
team.
If you look at it, the slide actually says Ben designed this slide on the bottom of the slide.
Your design team disavows all participation in this. This is Ben only. He has to own it. Right.
So the whole idea is I think it's really important to create an image that communicates the essence of this idea, which is that you bridge public and private markets with some sort of financial innovation, which I'm calling our public venture funds or PVCs or VCX. But the concept is you let the companies stay private, let them innovate, let them do what they do best, and let the public investors have access through some kind of regulated entity. And this is like how I would describe the concept visually. They have other designs, which I'll show you. But anyways, I was very excited about sharing this and letting the design team hate it. Okay, next slide. Okay. This is happening now in a specific context, which is AI has changed the need to democratize markets, right? It's become almost a moral imperative because there's a possibility that AI grows and goes to places we never would have imagined possible. Like if AI becomes more like people, we have AGI, we have this general intelligence, artificial general intelligence, and we start to replace people with machines and replace workers with AI. It could radically change how people like actually get paid and what they get paid for. And so it starts creating this sort of almost an existential question about who owns this AI revolution. So it's not just a problem that generally has been the case for 20 years. It's now become a problem that specifically it was acute at this moment in time.
Yeah. And I think in economics terms, what you're getting at here is that if AI ends up automating away a lot of human tasks, human jobs, then there's going to be enormous returns for the people who own the AIs, right? For people who own like the companies that end up doing all the automation, right? But it's going to be tough obviously for the people who lose their jobs and maybe have to retrain, have to wait it out until like the economy sort of restructures and so forth. And so if you democratize the ownership of the AI and the companies that make it, which many of which are private, okay, then at least there's some protection for the workers who end up losing out because they might be at least invested in this company, and the gains will be more widespread. It won't just be a bunch of super rich shareholders who have access to these gains. It'll be everybody.
Right. So if we go to the next slide.
I could see as I was going through it, you were like just itching. You're like, yes, I already thought of this, Cardiff. All right, let's do it. All right. How will AI change the future? There you go. That's that is exactly in. This is from your design team. I take it they came up with this conceptually. This
yes.
is great. All right.
So
we're back, baby. We're back.
Yes.
No more funky Ben designs. All right. This is very nice.
So the way I was thinking about it is that like, okay, if AI takes my job and my 401k is $100 million. Like maybe I'm okay with that. Like maybe that's okay.
I think so. Yeah.
But if AI takes my job and my 401k is $100,
yeah,
and like these other 10 people are each worth $10 trillion, right? Like I'm not so happy.
Of course. Yeah.
And so this is not just like an economic problem. It's not just a moral problem. This is a political problem. This is a huge social problem. Because there's like the people who work in the AI companies really believe we're going to get to this artificial general intelligence. They really believe it. And most people in the public don't believe it, but they're afraid. And so creating sort of this democratic ownership is like, it has never been more important than it is today.
Yeah. Okay. Great. I'm glad we front ran that one. We're in alignment on that.
We're on the same page.
Yeah,
okay.
absolutely.
Next slide. I had some numbers here because I think it's interesting. It gets at both like the impact and also the economic opportunity, which is that there are 100 million white collar workers in America. And if you look at the kinds of work they do, like I believe AI is going to do a huge part of this work. You and I have talked about this in other podcasts. I'm actually less concerned that it's going to replace like people and it's going to like automate everything away. I think it's going to automate some big percentage of the work. So as you said, the tasks. Today, maybe it does less than 1% of your work, but I think over the next 5 years, it probably ends up doing a bigger and bigger share of your work.
Yeah.
And these are the type of work it can do. Clearly, it can do customer service. Clearly, it can do copywriting. Clearly, it can do paralegal work. And so this type of work, even if it does a percentage of the work, it's still a lot of impact and a lot of economics and huge social consequences. So if you go to the next slide, I have done some.
By the way, I just want to note, podcasters not on the list. So there you go.
Yeah, no, we're good. We're good, Cardiff. So this is like I've done some research around this, and we can debate this, but like I think that you're talking about AI doing a greater and greater percentage of the work. If it does 3% of the work, that's equivalent to 2 million jobs. Not necessarily displacing them, but 2 million sort of equivalent like FTEs. If it does like 8%, if it does 17%, if it keeps taking a bigger share of the workforce, it creates effectively AI workers, artificial workers who are doing work. And I think we're going to see millions, tens of millions of AI co-pilots. And I think the practical consequence of AI is that you have a worker, human worker, who has multiple AI co-workers, and the human worker does the work of 2, 3, 4, 10 times the number of workers he used to be able to do, the amount of work he used to be able to do. And so it's not that it's displacing all people, it's displacing some people. And I think that is the actual likely consequence. And it still has the same moral and social and economic consequences for who gets to own it. And I think the fear of like this sort of Terminator is distracting us from the actual risk and the actual likely scenario, which is that it's going to have this huge impact on society. It's going to have huge economics, and we need to start doing things to make that a successful outcome for us, not just like an unequal outcome.
Can I just like emphasize one point though, which is that something like the democratization of markets where more people have a stake in the gains from new technologies, that can be a good thing, whether you get the mildest version of this scenario where AI has some effects, but they're not enormous, or maybe they're a little bit more transformative than previous technologies, but it's not this huge displacement. It's a good thing if we get that scenario, and it's a good thing if we end up with the more drastic scenario of this widespread displacement, huge societal, upheavals at the workplace and things like that, right? So like what you want, both in public policies, but and in ideas like this, is something that leads to a healthy outcome regardless, right? So it's plausible that you end up with this radical scenario, in which case this is great. But even if you end up with the, frankly, also plausible milder scenario, this is still good. This is something that would have been good 30 years ago too. You know what I mean?
Yeah.
We don't actually have to debate this to say, well, this can be a healthy trend.
Yeah, there's a spectrum of possibilities. And so you and I, Cardiff, you've never seen this deck, but if you go to the next slide.
Oh, here we go.
So there is like a pattern of how tech has grown. If you go back to personal computers, like the amount of work it could do, automated, there used to be pools of typists who would sit in the middle of the office and do all the typing. There was no Excel spreadsheets. Everything was done with actual paper. And so as technology has progressed, it can do more and more it can automate more and more work. And as it automates more and more work, its market share, its market potential has grown. And so, mobile made it possible. Mobile phones, mobile technology made it possible to have Uber and Airbnb and things like that. And so there's as you said, there's a range of possibilities. And I think the more likely possibility is that AI does a lot of valuable work, and it opens up new sectors that couldn't have been automated before. And that's a multi-trillion-dollar opportunity for whoever is an investor in it.
Yeah.
So as you said, there could be existential fear or it can be great economics, but anywhere in that range, democratizing ownership is a good idea.
Indeed. Okay, great.
Okay. So let's get into VCX, because I feel like, next slide, that the questions are, okay, but you've talked about this in concept. How does this actually work? Why are you guys, are you guys any good at this? And here's the design team's version of this slide.
Beautiful.
Of the bridge. If you look at that bridge is actually a Bifrost.
Okay.
Do you see it?
Yeah.
Yeah. See how it's like anyways.
Very nice.
Yes.
Right.
They did it.
Solid folks. Yeah.
I'm good, but they're better. So anyways, so this idea of, okay, fine. I buy the concept generally, but do I think that you guys should be the one bridging it?
Yeah, I have a feeling people are also wondering at this point, what have you invested in that would make this specific public venture capital fund worthwhile, right? Not just because the concept they might agree with, but have you nailed it, right?
Yes. I'm so glad you haven't seen this deck, but it seems uncanny. Because the next slide. So this is the...
there's the list. There's the list.
There it is. So this is the portfolio of the Innovation Fund, of the public ticker VCX. And so the fund owns what I believe are the top private tech companies in the world. Especially in America. And so what's happening with AI, if you think of AI, right? OpenAI, Anthropic, SpaceX or XAI, Databricks, these are the companies they're changing the world in the private markets. And these are the companies we've invested in. I'd love to get into some of these in more detail, but generally the takeaway, if you go to the next slide here, is that portfolio is heavily concentrated in these companies, right? What people want are the top companies. They want the AI companies. And the portfolio is well more than 90% concentrated in these top tech companies.
Yeah. And of course, at the top of the list there is Anthropic. And now I also understand, I think part of the reason you're bringing up these scenarios for AI, it is Anthropic's release recently of, the latest version of Claude, that has allowed these kind of agentic coding, technologies to I don't know, it's led to a lot of speculation that things really are about to change, that something is happening, and that a lot more of the tasks of white collar jobs are now available to be automated than people had realized. And we kind of exist in this strange liminal space right now where there has not yet been widespread application, but in some parts of the tech world, there has been. And that part of the tech world is basically telling the rest of the white collar workforce, it's coming for you guys too, right? I want to be clear, like we'll see, right? But the potential for something like that to happen appears greater now than it has in the past, a lot greater now.
Yeah. So our biggest position in the fund is Anthropic. We invested in Anthropic 3 years ago. Anthropic's a good metaphor for what's happening, what I think is going to happen. And so when we invested in the company, I think it had like $20 or $30 million in revenue 3 years ago. And at the beginning of last year, they had $1 billion in revenue.
Mm-hmm.
At the end of last year, they had $10 billion in revenue.
Right.
Okay. It's insane.
Yeah.
And yeah, Claude Code. So you and I did a podcast in December where I was arguing, hey man, this stuff with AI is like, it's happening. It's real. Like, I know that people haven't experienced it mostly firsthand, that they haven't seen how it's going to like eat up so many of the tasks they have to do at work. But I'm like closer to the work. We built this business called Real AI, which is a real estate AI vertical for real estate professionals. And like, I'm telling you, it's here. And you're like, yeah, totally. But we don't know.
Yeah, I have shifted a little bit in your direction. My default scenario to this thing is always, we don't really know.
No.
And there's a lot of variety in how this stuff works, right? Like different parts of the economy will move at different speeds. I think what you're doing is moving very fast. In the software development world, this is clearly moving extremely fast. Other parts of the economy have like specific barriers that make it harder to implement things. And in some ways, you could say that those parts of the economy will actually like fall behind the rest of the economy. But it also means that those parts of the economy, in some sense, the workers in those sectors are a little bit more protected, right? I don't mean that in like a good way or a bad way. I'm just saying that like the speed at which these things move is not, it's not like one monotonous thing. It's a whole bunch of different ways.
Right, the diffusion problem. But I'm really optimistic about the way this will play out. I think that there's a win-win possibility that's most likely, whereas that the white collar workers automate a lot of the grind and stuff they don't like to do. And that causes huge growth. They get paid more. There's growth in the economy. Actually, AI probably drives inflation down because essentially technology is a disinflationary force. So I think that there's a win-win-win outcome here. And I think people's fear is getting a little bit in the way of actually like some of the good policies we should be having. But the point is, there's a range of possibilities, and Anthropic's showing that you can automate software, software development, software programming in ways that were unfathomable 5 years ago, just completely like the sci-fi.
Yeah. And that's your biggest investment.
And that's our biggest investment.
Yep.
I actually like, if you go to the next slide, I actually kind of highlight this a little bit, which is that about half the fund, almost half the fund is in these sort of AI leaders, OpenAI, Anthropic, Databricks. So what we did is we concentrated the ownership or the investments in the fund in what we thought were the most transformative AI companies. And, when we first invested in some of these companies, like, it was not 3 years ago, no one was saying like, this is what's going to happen. And so a lot of like grief I get from people like, oh, why are you a good venture investor? And, I'm not the best venture investor, but we have a track record of making great investments, great companies. And actually, if you go to the next slide,
by the way.
And well, I mean,
you had a funny appearance on CNBC at one point where I think somebody said, what's the difference between like the investments you've made and somebody investing in like, and you said something like, well, we were there first. Or something like that. Right?
Yeah, they asked us like, because other people are following us into this idea of public venture capital. I think it's going to become a category, like ETFs are a category. And somebody said, oh, there's other companies are doing this. How are you different from them? And I said, well, we did it first.
Mm-hmm.
Yeah. So being first, it can help. There's no guarantee though.
It always helps. All right.
So if you look at the next slide, is historical performance, which is the most regulated part of everything I'm going to have to say. But the point is our historical performance over the last year, and actually even in the last month and a half, has been really good. And it's because of the companies that we own. I mean, the companies that we invested in are just doing all the work. All we did was just invest in them.
Yeah. And nothing surprising about this slide, given the names that you just showed on the list and the fact that you were already there. So yeah,
it's awesome. Good. It's awesome. So okay, next slide. Just a little bit about the size of the fund. The fund is more than 550 million, getting on 600 million. So it's a meaningfully sized fund. But one of the biggest difference, maybe the biggest difference between our fund and a normal venture fund, we have almost 100,000 investors in the fund.
Mm-hmm.
A normal venture fund actually is limited. You're not allowed to have more than 100 investors in a venture fund and still be a private fund. There's a rule. And so the idea that we democratize investing into these companies and they're not, they're pre-IPO, maybe SpaceX goes public, maybe OpenAI goes public, but our 100,000 investors invest before. That is completely novel, and I think like exactly the type of things we're all about.
Mm-hmm. Excellent. All right.
So okay, let's get diving deeper here. So here's some interesting stats that you may or may not know, but like so the AI companies are growing faster than private tech companies have ever grown, I think, in history. The next slide. So like if you look at like public tech or just other types of tech companies, they're growing like 15 to 25% a year, and the different kinds of AI tech companies are growing hundreds of percent a year, just way faster. And those AI companies that are growing hundreds of percent a year, they're private.
And are we looking at valuations here or revenues growth? Okay,
growth in their revenue.
Right.
Okay. So if I go to the next slide. So here's a really fun stat about VCX. So VCX holds a portfolio of private tech companies. QQQ owns a portfolio of public tech companies. The weighted average growth rate of revenue of QQQ was 25% in 2025. So the companies that QQQ owns on a weighted average basis grew 25% last year in their revenue. And in VCX, it grew 193% in 2025. So way more growth.
Yeah. That I should say is not as surprising. I mean, these are young-ish tech companies, right? Whereas, I mean, the S&P 500 is, the biggest companies in the country, and those are established companies. You know what I mean? Like that makes sense. This is sort of what you'd hope to be able to capture in something like this, right?
Right. I mean, if I think about it, as you said, more systemically, less about the specific companies, the idea of creating a way for people to invest in younger, faster growing, arguably higher risk companies, like you can gamble, right? You can do, online speculation about like, betting about what's going to happen in the future, with poly markets and all these sort of like high risk things, but you can't invest in these high risk, high growth companies. Like, right. That doesn't make sense. Just doesn't make sense. So like right now, this is our growth in our portfolio, but like, it could change. But I think in general, younger companies grow faster.
Of course. Yeah. This, by the way, is part of the imbalance that you're trying to address with
right.
something like this, right? Okay.
Hey, go to the next slide. I'm going more and more into the weeds here, but here's just some stats for people who are where we're in the public markets. Lots of public market investors want, financial details. So here's in more granularity, which is here's the growth rate of our portfolio versus QQQ's portfolio. It's on a weighted average basis.
Mm-hmm.
And so VCX grew 7 times faster than QQQ. There was a slightly higher revenue multiple than QQQ, but it's something like you're paying maybe like a 60% higher multiple for 7 times more growth, right?
Yeah.
So you're just getting a better price per growth.
Yeah, I mean, growth companies traditionally anyways have higher multiples, so that's fine. That's normal.
Yeah, it's just the question is like, when we get later down to the question of like, where should it trade? I think that part of it is like, how do you price the growth?
Right. Okay.
One more really weedy thing, and we probably we will move on too much. But the point is that like, VCX is way more concentrated. Our top 10 companies are 70% 55-ish% of the portfolio, and QQQ, the top 10 companies, are 48%. And so like it's a very concentrated investment in what we think are the great companies. People may think that's smart, people may think that's not smart, but it's just like that's what we're offering.
Or it's not so much about smart versus not smart as it's riskier, right? The way we traditionally understand risk, this is riskier to have a more concentrated portfolio.
Right. I think hey, for my compliance folks and regulators, like, yeah, there's a lot of risk investing in private companies, in any specific investment portfolio. So like, and all of these returns you're seeing, past performance, not indicative of future results. I said it. I want everybody to understand there's risk, there's uncertainty. Here we go.
Yeah. Listen, compliance and the lawyers are going to be thanking you for saying that. Absolutely.
Yeah, I'm glad I said that. Okay.
Okay.
Okay. So now when I get into it, this is the last slide is about Q&A. And so if you go to the slide after this one, I have some Q&A. And so I anticipated the question you're going to ask, which is basically about how do we think about this being priced in the markets? Like how do public venture capital funds end up getting received by the market? And so if you go to the next slide, that's like what I'm trying to frame it. And so
how will this trade?
How will this trade? How will the market understand it? And so one of the things when we announced this to our Fundrise investors, 100,000 investors in the fund approximately, most of them dumped it into ChatGPT and asked ChatGPT, how should I think about this?
Yeah.
And I think ChatGPT misled them because it's so novel. ChatGPT or any AI model, and I love it. I love ChatGPT. We're investors in OpenAI. But
Sure.
what happens is it's a backwards looking product in a sense. You get the average of the history. And so it looked at this concept of a public venture capital fund and said, well, the regulatory wrapper is a closed-ended fund that lists, a listed closed-ended fund. And most people probably never heard of a listed closed-ended fund, but ChatGPT has. And it said, oh, this is like a listed closed-ended fund. And so it will trade like a listed closed-ended fund. And I'm like, no, I don't think it will. But that was the most common question or misconception. And so I want to answer that question because it's a more granular way of answering the question you asked, which is, how do you think the public market is going to think about it?
Yeah. To be clear, closed-end funds traditionally trade at a little bit of a discount, a little bit of a penalty to the underlying assets that they're invested in, right? To the net asset value. And
you know more than most people. Yes.
But the reason I know that, but the reason I bring this up is also because the question in my mind was the portfolio companies that the Innovation Fund is invested in, those companies remain private. And so the fund itself will have a lot of like transparency, but you're still not going to have the public market transparency in those portfolio companies themselves. And so I was wondering if there would be a kind of penalty in the trading of this fund, once it's on the public markets, just because of the disparity there between like the transparency you usually get with a company that's listed on the stock market versus the portfolio companies that this public fund is invested in.
Right. So that you're the best, Cardiff.
Oh, thank you. I'm just asking questions here.
But you're asking the right questions. And so, yes, so closed-ended funds typically trade at a discount to their NAV. And that is what is the risk of us listing the fund. It may trade at a discount to NAV. And that's very common. And the average closed-ended fund traded at about a 5 to 7% discount in January last month. So that will give you a sense of kind of how much the market will discount on average closed-ended funds. But let's just talk about closed-ended funds because this is exactly what ChatGPT said. And so we go to the next slide.
But ChatGPT is right about that traditionally closed-ended funds do trade at the... Yeah, okay, so that's...
Right. The ChatGPT was right about closed-ended funds.
Okay, all right.
So what is a closed-ended fund? A closed-ended fund is a fund that typically holds public stocks and public bonds. Mm. And I asked ChatGPT, what are the most common holdings of a closed-ended fund? And it was Microsoft, Apple, Amazon, Alphabet, NVIDIA, Meta. So it's public stock. So you basically take a public stock that you can buy and wrap it in another vehicle that has a fee load of maybe 1 or 2% a year. So it trades at a discount because basically you're buying the exact same thing you can get in the public markets with more expense load. Mm-hmm. So it's not surprising to me that a closed-ended fund would trade at a discount to NAV, because the NAV is, you could in an efficient market, you can get that NAV.
You're losing a small cut.
You're losing a small cut of it.
Yeah. Okay.
And so, and there's 383 listed closed-end funds. Okay. A PVC, or a private venture fund, right? It holds private tech companies. So like SpaceX, OpenAI, Databricks, Anthropic, Anduril, Ramp. So that is such a different portfolio than Mag 7, than public tech.
Yep.
And so when they say, oh, but it's like it trades at a discount, I say, well, we don't really know, because the assets are so different. Ultimately, it wants to trade based on the market's expectations of those assets. Not, I mean, the regulatory wrapper is kind of irrelevant. Should be irrelevant. And that's actually often been the case with other inventions. Like the ETF is just a reinvention of a mutual fund. A money market fund is actually a reinvention of a mutual fund too. Mm-hmm. And they became normalized, and people don't think of them as like a form of mutual fund. And this is also a 40 Act fund structure. You just reinvent the kind of assets it holds, the kind of like parameters you follow. And I think we'll create this category of PVCs, and I think they'll trade different from closed-end funds, normal closed-end funds. How they trade, I don't know, but I think that they're going to be seen as a different asset class for logical reasons.
Mm-hmm. Okay. And in terms of what you think the Innovation Fund, or VCX, is going to do, how do you think it's going to stand out or differ from these traditional closed-end funds in terms of how it ends up trading, given the comparison that you just made?
Well, okay. So that's something I'm not allowed to say.
Okay.
But let me keep going here.
I never know when I'm tripping the wires here.
No,
man.
you can ask. I just have to. I have to be very careful.
All right, fair enough. Fair enough. Okay, great.
So yeah, so if you go to the next slide, the question you're asking is should a PVC or should private companies trade?
That's basically what I'm asking.
Should it trade at a premium or discount? And so what I want to do, because this is the regulatory learning I have.
This is the tricky part.
Is that you want to present a balanced answer.
Okay.
And also I'm going to walk through this, but I'm going to basically, if you go to the next slide, I'm going to talk about it generally.
Okay.
Not necessarily VCX.
You go, basically. Talk about it generally. I won't even, in this case, I won't follow up, because I know this is where things get a little...
No, actually it's great if you follow up. You can say whatever you want. I just have to be really careful. So the first thing, we keep saying net asset value or NAV. I want to make sure people understand what that is.
Please.
And so the net asset value is all of the assets of the company. Mm-hmm. And so in our case, it's the private company investments. It's some liquid assets, cash, and you add up the value of all those things. And that's your total value, or your net asset value, because you might have some liabilities. Maybe you borrowed some money, so that would be deducted from the net value of the fund, and that's net asset value. Okay, so now we say, okay, we understand the math of it, but now let's get sort of inside of that. So if you go to the next slide, this looks at the net asset values of VCX, and you see, as you said, it's super concentrated in like these handful of companies, 10, 15 companies that we think we're really excited about. And if you go to the next slide, you sort of say, oh, how are we marking these companies, these investments in these companies? Mm-hmm. And generally we mark, or we hold the value of them based on where the venture funds priced them in the last round. So Anthropic just raised a round, Databricks just raised a round, OpenAI just raised a round. When they raise a round, you get a share price. We often invest in those rounds, but you get a share price. That share price is the price by which we generally hold the value of the stock in the portfolio. So we say, what's the NAV of VCX or any other kind of fund like ours? It would be the combined value of the shares plus cash and plus any liquid assets. And so understanding that essentially the NAV is the private market pricing of the companies.
Right. The one easy way to think about this is with a hypothetical. So if there's a closed-end fund and it owns, I don't know, I'm making things up here, but one share of a company that's worth $50 and a share of another company that's also worth $50, the net asset value is $100. So if the closed-end fund is trading at $95, it's trading at a 5% discount to the underlying, to the net asset value.
Yes.
Right.
Yes. Okay. So now let's go to the next slide, because I think this gets to the question.
Okay.
So I'm going to try to argue a balanced approach, which is that it could trade at a premium or it could trade at a discount.
Okay.
So why should a public venture capital fund trade at a premium? So here are the arguments for a premium. The biggest one is a liquidity premium. So you have the same assets or very, very similar assets as a private venture fund, but instead of being locked up for 10 years, it's liquid daily.
Right.
So normally you have to, if you're going to be locked up for 10 years, you're not going to get your money for a decade. You want to get higher returns. You want to get some kind of premium for being locked up. And so they call it typically a illiquidity discount or a liquidity premium. And so that's a huge difference. And I would argue, okay, if public venture funds traded at a premium, it's partly probably because they're more liquid. That's one.
Makes sense.
Number two is scarcity premium. So the top private companies are really hard to get shares in, really hard. It can depend on the company, but like in a typical round, in a great company, there's more venture fund investors who want shares than the company will have available. So they have an allocation. Trying to get an allocation requires relationships and lobbying and trying to do things that help the company. And so getting an allocation can be really difficult. I get emails virtually every day from big funds offering to buy our shares in our private companies. Hey, I'm a sovereign wealth fund in Singapore and I want to invest in, this company. Do you want to sell $300 million of your company? And so it's really hard to get these shares. And typically, like if you get them, you don't sell them. And if you want to buy them from somebody who has them, you're going to end up paying some sort of scarcity premium.
Yeah. That makes sense. It's something that you can't get. Now you can get it. So, you're willing to pay a little bit more because it's available now.
Right.
Okay.
And you're talking about getting it like in the most efficient way in the planet, which is public markets.
Yeah.
So super efficient versus super inefficient.
Yeah. Okay.
Right. And that's my next point. So there's an efficiency premium because people don't realize, because they don't have any they don't have any really experience with private companies. But like when we're trying to invest in a company, first thing, they only raise money, maybe once a year, once every other year. They only raise money once in a while.
Yeah.
The existing shareholders generally don't sell. If they sell, it requires company approval. Company approval often requires board approval. You need to be investing a large check to get, typically you're investing millions, tens of millions to get, a chunk of shares. These don't like go in small quanti.
Right.
So you're like, maybe typically our investments are in the millions of dollars, and then there's all these lawyers involved. They're reading there's subscription documents. There's all these. There's documents. So it's a long process, taking months, costs a lot of money. It takes a lot of approvals. So it's a very inefficient process in the private markets. Public markets, super efficient. So there's I would argue an efficiency premium between these two markets.
Okay.
And
these all make sense. And we're also, I think, speaking about it in sufficiently abstract terms that people will sort of get the point. But
yeah. I'm talking about public venture capital funds, not necessarily VCX. Sure. I'm just saying generally, I think how the sector will come to be understood, a category.
Right. Okay.
The last point is that, and this always blows the mind of like the people in the tech industry, they're getting these companies without paying carried interest.
Yeah.
Like you can't, to get into these best companies, get into like Ramp, which has been growing like crazy, and they put their numbers out. So it's like easier for me to talk about their 100% annual growth last year. You typically paying 20, 30% of the upside. So like the idea that you're not, and you're buying it for like $18 a share versus like millions, to get in. Like, that's so crazy. It's like, honestly, for the last year, when I've told venture players, like, here's our portfolio, they don't believe me. They're like, it's impossible. It's impossible you did this.
Yeah.
So anyway, those are the reasons why it may trade at a premium. But there are definitely, if you go to the next slide.
Yeah, here comes the other side. Although we already talked about a couple of these. So
right.
But yeah, this.
And there could be more, right?
Right.
I mean, like we don't know how it's going to trade. But it could trade at a discount, as you said. And so I think that the big ones are, I think the biggest one is that sentiment is highly volatile and expectations can change. So if a month ago, everybody thought AI was a bubble, and I think that like it could have been received poorly. People, AI is overpriced. These companies are overpriced. It's, this is not, we don't think this is right. And now everybody's gotten all excited again, and AI has gotten really hot. And but the sentiment for the portfolio could really affect the price of how it trades.
Yeah. Okay.
The second one is that they might say, okay, VC funds are investing in these companies at X price, X valuation of the company, but we think the private markets are overpricing it. And that definitely happens. That definitely happened in 2021, and it happened in the public markets too. But like, just because the private market is pricing it that way doesn't mean the public markets agree, and doesn't mean that it's a good price. It just means that's how private markets are pricing it. And so you could have a market failure in pricing.
Yeah, these first two, by the way, items here on this list, these are pretty standard. These are well known. Is something overvalued? Is it undervalued? Like, it's part of that universe of, is it attracting too much attention? That kind of thing. This is understandable.
Yeah.
And this is just about trying to arrive at the right, price. Like, am I investing in this at the right valuation?
Right. And I kind of expect it to go up and down.
Yeah.
So it could trade at a premium, and then it could trade at a discount. It could trade at a discount, could then trade at a premium. People's sentiment and expectations change a lot. And so even if it traded one way, it doesn't mean it couldn't change. And so at some point, probably over the life of the fund, it will trade at a discount and may trade at a premium. And so you should expect the unexpected.
Yeah. How many times can we say it? Podcast is not investment advice. All right. Go ahead.
Yeah. So, and then there's like two or three that are more specific to a fund. Like, do you think the fund manager is good at their job? Do you think they have good compliance? Do you think they're marketing the assets at the right NAV, right NAV? Do you think they are investing in like the right companies? Do you think that if they raise money, will they invest in more good companies? So there's very specific or idiosyncratic reasons why one PVC might trade at a premium or discount. If you look at closed-end funds, some closed-end funds do trade at a premium. And that's because there's trust in the manager or trust in the assets. And so, the market, I expect that the market will take some time to decide. It's not going to come out of the gate with something really new and know the answer. And so one of the fun things about being a pioneer is that, you'll get punished in the short run, normally, hopefully rewarded in the long run. So we're going to go out and do something that the markets there's going to be activists. There's probably going to be people shorting it. There's going to be people who are critical. Hopefully Matt Levine writes about us. And so it's going to be wild. I mean, it's really anybody's guess what's going to happen.
All right. Very part of the excitement. Very
so
exciting.
Yeah, that's the end of my presentation. We're trying to create this category of PVCs. And so, it's going to be a wild ride, Cardiff.
Right. Well, I think we covered all our bases, but is there any final thing you want to leave listeners and viewers with? Like the one thing you really want to emphasize about what's going to happen soon, or depending on when they see this, like what's just happened and why it's so meaningful?
Well, I mean, I'm just hoping that people believe in the concept of democratizing markets, and that they see the need and the rationale. It's for me, it's less about price. I think it's more about change. And I'm hoping that we can change the way the markets work. Which is the public markets have become a lot of the logic of democratizing investment has broken down because of the way that the systemic issues of the private markets and public markets and the barriers that have grown over time. And I'm hoping that we tear those down. And I'm hoping people want to be part of that change.
Yeah, well, I got to say, it was a super compelling presentation. I have a feeling that viewers are going to find it every bit as enticing and interesting as I did. So, all right, good luck.
Onward.
You have been listening to Onward, the Fundrise podcast featuring Ben Miller, CEO of Fundrise. I'm Cardiff Garcia of the Economic Innovation Group and host of the New Bazaar podcast. We invite you again to please send your comments and questions to onward@fundrise.com. And if you like what you heard, rate and review us on Apple Podcasts and be sure to follow us wherever you listen to podcasts. Finally, and for this episode, this is especially important to point out. For more information on Fundrise-sponsored investment products, including relevant legal disclaimers, please check out our show notes. Thanks so much for listening, and we'll see you next episode.
It was the stock market that started history's greatest wave of wealth creation. From factory workers in Detroit to farmers in Omaha, anyone could own a piece of the great American companies. But today, our most innovative companies are staying private longer, which means everyday Americans are missing out. Until now. Introducing VCX, the public ticker for private tech.